Professor Nam Yong Lee's long-form commentary, Bitcoin, Payment Failure and a Responsibility Vacuum, come before the digital gold myth. When you dissect the code, you see an agreement experiment, not money. Bitcoin is an electronic payment and settlement system that attempts to minimize reliance on trust institutions by maintaining a public ledger through open rules and network consensus. However, the essence of a payment infrastructure is not merely a transaction completes quickly and cheaply, but when something goes wrong, someone is responsible and the system can be restored. Real-world finance faces outages, errors, fraud, and disputes every day, so responsibility is built in through service-level commitments, cancellation and refunds, victim compensation, and supervisory inspection. Bitcoin pushed these responsibility functions outside the protocol, and from that moment its probability of failure as a payment infrastructure rises structurally. That is why Bitcoin's value tends to depend more on narratives, flows, and policy conditions than on technical utility, and that is precisely where investors face the greatest risk. The 21 million cap is not philosophy, it is a geometric series. Bitcoin's 21 million supply cap is a mathematical consequence of the halving rule. The block subsidy starts at 50 BTC and is cut in half every 210,000 blocks. So the total issuance is the sum of 50 times 210,000 plus 25 times 210,000 plus 12.5 times 210,000, which converges to 21 million BTC. This cap is not unchangeable, but changeable only at an extremely high social consensus cost. In other words, it is not code alone that enforces the promise. It is a complex equilibrium among exchanges, custodians, miners, institutional capital, and regulators. Investors must be sober here. The cap supports a scarcity narrative, but when payment utility and responsibility structures are weak, scarcity does not guarantee price. The market responds instead with higher volatility. Payment performance ends with arithmetic. It becomes slow, small, and expensive. Bitcoin assumes a 10-minute block interval, and its on-chain throughput is often described as roughly 3 to 7 transactions per second. That is less a payment rail and more a settlement layer that auctions scarce block space. A benchmark makes this unmistakable. Visa's payment network is designed for orders of magnitude higher throughput, and global best practice in payments assumes high volume, near-instant confirmation, and recoverability. Bitcoin is structurally misaligned with that standard. Fees further degrade payment suitability. During congestion, fees and mempool backlogs surge. During quiet periods, blocks can be relatively empty. The user experience oscillates. Payment systems live or die by predictability, and Bitcoin has difficulty producing predictability by design. Therefore, claims that Bitcoin's base layer can be scaled into a universal payment rail collide repeatedly with physical constraints, block space, propagation delay, and verification cost, not with marketing. The warranty gap is not a technical bug, it is an operating design failure. In traditional payments, who is responsible is settled by contracts and law. In Bitcoin, there are developers, miners, and users, but no single party that provides a warranty for outages or defects. As a result, core functions, cancellation, refunds, dispute resolution, and compensation cannot be natively embedded in the protocol. Exchanges, custodians, and wallets try to fill the gap, but that creates centralized single points of failure, concentrating hacking risk, internal control failures, and insolvency risk onto users. Bitcoin claims decentralization, yet real usage often becomes dependent on centralized interfaces, while warranties remain incomplete. That is the recurring contradiction: failure in payment usefulness and failure in warranty at the same time. The critical point is that this contradiction has not been fundamentally resolved by technical updates across Bitcoin's operating history. Available is not the same as frequently used for payments. Payment adoption has a wide gap between a merchant can accept it and people actually use it regularly. Many surveys and market observations point to limited routine payment usage, which suggests Bitcoin's role as a day-to-day payment instrument remains constrained. When payment utility fails to dominate, what remains is investment and speculation demand. Then price becomes more sensitive to flows, leverage, sentiment, and policy headlines than to fundamental cash flow anchors. That is why Bitcoin looks weaker when evaluated as payment infrastructure and riskier when evaluated as a narrative-driven investment asset. Market cap and 15-year volatility, numbers that show not fit for payment. Bitcoin's market capitalization sits around the trillion-dollar scale, reflecting price multiplied by circulating supply. That size often gets misread as proof of maturity, but market cap does not solve operational suitability. Volatility is the simplest diagnostic for payment fitness. Over the past decade plus, Bitcoin has repeatedly exhibited volatility far above what a unit of account and medium of exchange can tolerate. Even if volatility has moderated compared with early years, it still remains high enough to prevent stable pricing, wages, taxes, and debt contracts in Bitcoin terms. In short, high volatility itself breaks the monetary functions that payment systems require. 1 year, 5 year, 10-year price outlook. Only scenario ranges are honest. Stating a single target price is the most dangerous posture in Bitcoin analysis. The honest approach is scenario ranges that reflect policy, liquidity, custody infrastructure, and technology risk anchored to the current price level. 1 year, around end 2026, a broad band is plausible because with volatility near historic levels, large drawdowns and large rallies both occur with regularity. Exchange-traded fund, inflows and risk-on conditions can lift the top of the range, while macro-tightening, regulatory shocks, or major incidents can drive the bottom. 5 years, around 2030, an even wider distribution must be assumed. The decisive factor becomes whether institutions structurally embed Bitcoin into portfolios or whether regulatory, tax, environmental and custody risks remain persistent enough to suppress durable allocation. 10 years, around 2035, tail risks dominate. Quantum computing risk, if perceived as an abrupt trust break event, thickens the left tail. Conversely, if regulated custody, insurance, auditability, and controls become robust and widely trusted, the upper tail scenario remains open. The central point is not price prophecy, but loss structure when risks materialize. Central bank digital currencies, genius-style stablecoin regimes, and quantum computing. Forces that shape Bitcoin's price, CBDCs, represent the construction of official digital payment rails by central banks. As that architecture matures, Bitcoin's already weak position in payments is likely to weaken further because CBDCs aim to deliver fast settlement, governance, and accountability within the legal system. A stablecoin regulatory regime like the US Genius-style approach strengthens accountable payments through issuer obligations, reserve requirements, supervision, and enforcement. If stablecoins provide what Bitcoin struggles with, speed, reversibility frameworks, consumer protection under law, then Bitcoin becomes even more clearly categorized as a high volatility investment asset rather than a payment instrument. Quantum computing is not a distant fantasy, it is a preparedness problem. As post-quantum cryptographic standards mature, systems that rely on today's public key assumptions face transition costs. Bitcoin may be able to adapt via upgrades, but the social consensus and migration costs are large, which makes it a risk that markets can price in well before full technical capability arrives. China's ban and America's permission, the objectives are different. China's posture has emphasized strict restriction, viewing crypto through lenses such as capital flight control, financial stability, energy consumption, and speculation containment. The US SEC's acceptance of regulated exposure, such as spot Bitcoin ETP ETF products, should not be read as praise or warranty. It aligns more with moving exposure into a supervised framework, disclosure, surveillance, and regulated intermediaries, while explicitly warning investors about risk. The investor takeaway is straightforward. Both policy directions, in different ways, tend to tie Bitcoin's price more tightly to policy variables rather than improving Bitcoin's payment utility. A single practical prescription for investors: Bitcoin is already structurally unable to compete with modern payment networks on throughput, confirmation time, fee predictability, and reversibility, and it remains a platform with a built-in warranty gap in responsibility, compensation, and dispute resolution. Yet price can persist because the demand is driven less by payment utility and more by scarcity narrative, speculative hedging demand, and regulated product access. Therefore, Bitcoin must be managed not as future money, but as a high volatility policy and narrative asset. The investor's checklist must prioritize volatility metrics, regulatory developments, CBDCs and stablecoin regimes, custody/exchange incident risk, mining concentration and energy policy risk, and the degree to which quantum risk is being priced. Thank you for watching Professor Nam Yong Lee's long-form commentary.